So good morning, everyone, and thank you for joining us this morning. We're delighted to once again be co-hosting this event today with BRI Wealth Management. We are recording the session today for those people that are unable to attend, or if you'd like a copy of the session afterwards, please do let Wright Hassell know. So my name's Sarah Perry. I'm the managing partner of Wright Hassell, and I've got the delightful task of introducing this morning's session. So after last night, we now have a roadmap out of the current lockdown. And as we approach the budget, the debate in the UK has intensified about the prospect of when, how, and by whom we will start to pay back some of the unprecedented support that the economy has witnessed. So is this going to be the quantitative easing money tree that's going to keep on giving? Or maybe it's now a time to return to decades of austerity. 2021 is going to be a year of transitioning, barring any unforeseen catastrophes for us as individuals, businesses and society. And I think we can look forward to shaping our futures whilst recognising that the UK faces huge dual challenges of recovering from COVID and forging a new identity post-Brexit. So will the spring and summer be seasons of hope from which we will not come back, as Boris said yesterday? And will that hope translate into market confidence? And I'm really looking forward to hearing Dan's global market update this morning, which is going to tell us the answer to all of our questions, as well as he promises me predicting the outcome of the budget next week. And I'm sure that he's actually got a great deal to talk to us about today. So I'm now going to hand over to Vince Hopkins of BRI to introduce today's presentations. Could I just say that if you do have any questions for Dan or for Vince, then could you please put those in the Q&A. So over to you, Vince.
Right. Sarah, thank you very much indeed for that introduction. You're not asking for too much by the sound of it. But thank you to Wright Hassell for allowing us to come and present today. I'll shortly hand over to Dan, who will take us through his view of global markets and answer every question that Sarah has posed. Dan will start by looking back at where we've come from, which is probably the easy part. He'll talk about where we are at the moment, which is slightly more tricky, and then get into our thoughts for the future and themes that we think will happen and they're going to play out, or how we're playing them out in client portfolios. This is usually the bit where I do talk a bit about BRI and talk about the advice around pensions and inheritance tax and how we manage people's savings in the most efficient way. But as Sarah mentioned, there is the budget coming up next week. and it's the first of two budgets. There's another one scheduled for November. And that's probably of more importance to people. There's always a lot of commentaries about what's going to happen in the budget. It's a complete frenzy at the moment, as you can imagine, against the backdrop of the awful pandemic. What I did see yesterday, one of the top 5 accountants actually had a survey and had over 1,000 respondents to sort of some of the thoughts of the budget. And some of the things that came out, I thought I'd just share with you, if that's okay. 42% of the respondents are against any tax increases in the next 12 to 18 months. Well, good luck with that, lads. We think we know where we are. But there is some other interesting aspects of the budget. For instance, we are expecting, and 85% of the respondents are expecting increases in taxation when it comes to either online or digital services. So expect to see that happening. People who've actually benefited from the pandemic. Talk of a wealth tax, a one-off wealth tax, has started, but has slowed down in recent months. More focus on the capital gains tax, the CGT side, and the IHT side. We don't think it will be as draconian as some people are saying to begin with. I think there's definitely a direction of travel that we'll see. And obviously with the second budget coming up later this year, we can imagine that things will be started and then carried on. Dan is going to cover some aspects. I won't try and sort of duplicate that, but the economic fragility is one thing that Rishi Sunak has to manage. Stamp duty is an obvious one. We all love talking about houses. The holiday that we've seen has caused quite a quite a surge in activities. I'm sure Sarah and her conveyancing department can tell you all about. General thoughts. I did speak to the chairman of a public house building company yesterday. He's talking, or the word on the street at the moment is an extension for another 6 to 8 weeks. Possibly that's just a nice soundbite to have out of the budget because it will grab headlines. We do think that the government is also going to have a look at business investment as well. It's going to have to get confidence back in there. So whether it's areas like capital allowances, whether the Brexit freedoms enable him to do other things, or other schemes for investment like EISs or VCTs, which we also advise upon. But there will be a steering definitely towards supporting the green agenda for the government as well. So whether we're going to see allowances or encouragement in that sort of area of reducing everybody's carbon footprint. Finally, before I pass over to Dan, we all know how devastating the pandemic has been to the hospitality sector up and down the country. We do think we'll see encouragement, whether that's the continuation of the VAT cut, and I think we all know about the Eat Out to Help Out scheme that came up last year. We suspect this year there'll be similar help, but it'll be more like the Go Out to Help Out for the economy. So without further ado, and after that very motivational piece from me, I'd like to pass on to my colleague, Dan Boardman-Weston.
Thank you, Vincent and Sarah. So look, I'll probably spend sort of 35 minutes or so, maybe a tiny bit longer, just sort of going through where we've been and more importantly, where we think we're going with everything. And just to start with a quick recap, I mean, it's a year we all want to forget, 2020, and especially from a market point of view. We had the quickest bear market we've ever seen during 2020. Within the space of a month, it was about this time last year, it sort of started to happen, actually. Most major stock markets fell 40%. And that was a pretty challenging and scary time for the market, when you sort of go into the office and sort of day after day, you're seeing the market fall 10%, then it falls another 10%, another 10%. It was pretty scary times. But what we've seen since then is, I think it's fair to say, a truly remarkable recovery in the stock market, with most major stock markets making all-time highs at the tail end of last year and continuing into this year. And so you can see, last year the S&P 500, the American index, was up 14%, or emerging markets were up a similar amount. But what's interesting is that the UK market was still down nearly 12% last year. And that's quite a big difference between the American market, a 25% performance differential, which I'll sort of touch on in a little while. But the question is sort of, why did markets rally? And it's several points really that I'll cover in a little bit of detail. The first is the fiscal and monetary response that we've seen has been truly unprecedented. It is just humongous, and I will talk about that in a little bit. The shape of certain stock markets, what I mean by that is what sorts of companies are on the American stock market or on the UK stock market, and also expectations of a relatively quick return to normality. We've seen Boris last night laying out his roadmap, and this is what markets have been expecting, that it was a problem until sort of mid this year, and then sort of we all go on our merry way and can sort of do the next market update seminar in the pub, which I would be fully in favour of. So I have mentioned that UK assets significantly underperformed last year, and a lot of that was down to Brexit, to be honest. Pleasingly, that's sort of resolved now, which is good. But also, we have been hit a lot harder by COVID than a lot of other countries, which hasn't helped. And also, we do have a lot of economically sensitive stocks. We've got a lot of banks, we've got a lot of miners, a lot of oil and gas companies, all of which were having a tricky time last year, I think it's fair to say. But where now is the trillion-dollar question for markets? So just looking at a few graphs and tables. So I think many of you may have known that high growth and technology stocks have been the star performers over the last 10 years, but especially during 2020. So the technology index in America, for example, went up 50% last year. It's a huge amount. It went up. But the UK market, as I said, went down 14%. And a large part of the reason for that is that the UK on the stock market has got no exposure to technology. The world stock market has an 18% weighting. The UK market's got a 1% weighting. It's negligible. Ocado is basically the only company that we've got that does any sort of technology investment. And that meant our market was relatively under-loved. And as I've said before, a lot of economically sensitive stocks, such as banks, which aren't helped by the interest rate environment that we're in. But I think there is one important point to note through all of this sort of noise is where else can people invest apart from equities and potentially property, either commercial or residential? Because if you go back to the halcyon days of when I was just a twinkle in my parents' eyes of the 1980s, when interest rates were 15% or so, and you could get double digits on a government bond, that's fantastic. But roll forward to today, you can only get sort of about 0.5% on a 10-year gilt in the UK, or about 1.1% in America. So it leaves investors very little choice about where to invest other than equity markets over the long term. Just looking at the monetary and fiscal response, the graph on the bottom left-hand side of the page shows the quantitative easing that we've seen. So just to put this into context, from the start of the financial crisis in 2008 to 2018, when a lot of the monetary response started to unwind, there was about $11 trillion globally of quantitative easing, a huge, huge sum. In the last 11 months, we've seen $12 trillion of quantitative easing globally. So we've had more monetary response in 11 months than we have over the past, 10 years or so for the financial crisis. A huge, huge amount. And what really has been the kicker, though, also, is the fiscal response we've seen as well. The graph on the right-hand side shows that developed market debt to GDP ratios are at the highest since the Second World War now. We have had monetary and fiscal response firing on all cylinders, and this is highly, highly helpful for stock markets. And how this is sort of evolving and sort of evolving at the moment is that's a really powerful force, that policy we've got. But now what we're seeing is gradually improving economic fundamentals, or at least the scope for economic fundamentals to improve as vaccines are delivered and the country eases the lockdown. And that is a really positive trend for markets. And I think our view on this is that economics will get better over the next year, 2 years. There's questions about how we're going to pay for it all, etc. But the economy will come back, and it will come back in a strong form, and I'll touch on that in a minute. But we think interest rates are going to stay at this depressed level for a number of years. Policymakers aren't going to increase interest rates quickly. And if I was a gambling man, I would think they're going to be staying at this level or even go negative for the next 3 to 5 years. So again, that's highly helpful for stock markets. Just looking at sort of valuations for stock markets and sort of where we are today, I think it's fair to say some stock markets are expensive. So the graph on the bottom right-hand side of the screen shows the US market on about 24 times earnings, quite a bit ahead of its average since 1990 of 16 times. Yeah, and there are certain parts of the market, such as certain technology companies, that are eye-wateringly expensive. But if you look at other areas, Europe, the UK, Japan, emerging markets, they're all broadly speaking in line with their averages since 1990. They're not screaming expensive. If anything, I'd make a case that they're really cheap from a medium to long-term view, given that interest rates are so low. So I think the US is potentially an area to watch out. But I think generally speaking, equity valuations are attractive, especially coupled with the earnings growth we're likely to see over the coming years and the dividend growth. And that's what the graph on the bottom left-hand side of the page shows, is that the green bar, earnings and profits have declined massively last year as expected, but we're going to see big bounces in 2021 and 2022. And, hopefully we all get back to normal. And I think that is an increasing possibility. So just moving on to where we are with the UK economy, we've borrowed a lot of money, clearly, as Sarah mentioned. I think we'll have borrowed by the time this fiscal year's ended at about £370 billion, give or take. The highest level of debt in the post-war period, and I think the highest deficit ever as well, running at nearly 20% of GDP. It's quite remarkable when last year it was sort of 2%. And you can see on the graph on the bottom right, so the different measures where this money has gone: public services, employment support, business support, furlough, CBIL, things like that. And so it's been a huge amount. But I think the important thing to note, and it's been quite a subtle shift, unless you sort of watch it closely, is how the narrative over the last few years around debt has changed, especially at the governmental level. Who has heard the word austerity mentioned? The first time I've actually heard it mentioned is Sarah today. It's the first person apart from me I've heard mention that word. It's not around, whereas in the financial crisis it was. And the school of thought has changed. And you can sort of understand that to a certain extent, because take, for example, the financial crisis. If we borrowed £370 billion in the financial crisis, the annual interest rate costs alone would be £15 billion a year. A huge amount of money on that extra debt burden. Now, it's only £1.5 billion a year. That £13.5 billion a year difference is the annual budget for the police in the whole of the UK. So affordability is much less of an issue than it is now. So I think, generally speaking, we will have to pay it back, but there's a lot more tolerance to burdening a larger amount of debt within the economy and on the shoulders of governments. I think the other important point to note is that the government, I think, there has been a lot of economic pain and definitely in certain sectors of society, but I think the government has shouldered a lot of this. And actually, I'll come on to say why I think, generally speaking, and again, it's a barbell approach, but I think consumers and businesses aren't in too bad shape. I think they've survived this relatively well. And then the final point I'd just make is sort of on unemployment. And specifically, I think the success of the furlough scheme, and we did see unemployment rise to 5.1% this morning, the highest in 5 years. But the black line on the bottom left-hand chart is the American unemployment rate. They went from a 3.5%, 4% unemployment rate to 15% practically overnight. Tens of millions of people lost their jobs. Whereas in the UK, the furlough scheme has been so successful at keeping those jobs. Now, there's a big question about whether they keep those jobs going forward, but it has been hugely successful. So just talking about the consumer, as I said, I think the consumer's in good health. House prices are up. That all makes us feel better, about life. Mortgage affordability is good, I think, generally speaking, because interest rates are so low, and availability, I think, is broadly speaking pretty good. And of course, the housing market generally has been aided by the relaxation in the stamp duty, which has helped an awful lot. So I think people generally are feeling a bit better. And depending on which survey you look at, and metrics, house prices increased during 2020 by between 7 and 8%. Which is a huge amount, the highest in about 5 years. Clearly, there's some divergence in there. Inner cities haven't done as well, because actually working at home, we all want to be in the countryside and in outdoors and have space. But I think overall that's pretty good. But I think the key thing here for me is the graph on the bottom right-hand side, and that's the amount of money we've saved during the crisis. Alas, I have not saved. I moved house at the start of the crisis, so I can't say I've saved any of this £143 billion. But that's how much the consumer saved since March last year, £143 billion, with the savings rate the highest it's ever been since records began in the 1960s. And given that consumption accounts for so much of the economy, about 60% or so, as soon as people can open up and spend money, they are going to. Listening to Radio 4 this morning as I was driving into the office, Thomas Cook, holiday reservations up 60% overnight. Same with EasyJet, everything else. As soon as people can spend that money, they will. And so I think that really is going to power and drive the economy in the second half of this year as lockdown is eased and as we can go about our normal lives. That does have a negative effect in terms of inflation, and we do see that becoming an issue in the second half of this year for several reasons, namely because it was terribly low last year and economic activity is going to be quite a bit higher this year. But we don't think this is a persistent problem. We think it's a phenomenon for sort of a year or so, but it is something to keep an eye on. But just looking at businesses as well, business confidence varies depending on which sector you operate in, but it's a lot better than it was in March and April last year, and I think will steadily improve as we've got this route out of lockdown. And the government support, I think, has been very, very large and accommodating. And interestingly, bankruptcies have hit a 20-year low due to things, such as the CBIL or furlough or grants that businesses have received. That does raise an interesting point that actually it looks like governments are propping up businesses that probably would have failed anyway without the coronavirus crisis that we've seen. So it does raise an interesting point about zombie firms, but I'm conscious of time and I won't sort of delve down that particular rabbit hole. But I think the other thing also is if you take firms globally, they've raised a record amount of capital last year. This is publicly listed firms. They raised about $3.5 trillion via debt and equity. So I think overall, businesses are in relatively good shape and have got a lot of cash to spend. And I think the increasing confidence that we're seeing will lead them to spend that capital. So I can't predict the budget, but I do have a few thoughts that I would just say. I think the first thing is Rishi is keen to be a typical conservative and have an eye on the finances, which I think is absolutely right. We do need some sort of fiscal discipline. However, I don't think now is the time for that fiscal discipline. I think that will be in the other budget in November, when things look a bit better. I think that's when the serious tax rises will come. I think what you're likely to see in this budget, and it's sort of been leaked a bit, is corporation tax will move up by 1%, I think, towards the end of this year. I think that's what people are saying. And I think they're looking to target 23% over the medium term. And arguably, I think having a low corporation tax rate, I personally think is good, but I won't get into that. But we've got one of the lowest corporation tax rates in the whole of the OECD. So we're not out of kilter with everyone. And I think that's an easy way for the government to raise money in a sort of a politically friendly way. I think the other areas that have been mooted, but where there is a lot less certainty, is one, capital gains tax has been talked about for at least the last year, about harmonising the tax rates with income tax. CGT is a great tax. It's a very cheap rate of tax. However, reading the press over the weekend and a few other bits and bobs, it does seem sentiment might have shifted on that, at least in the short term, and that they might not do anything in this budget. They may do, but I think they're a bigger fish to fry. I think the other thing to mention is again, the stamp duty exemption. As Vince was saying, I think there is likely to be a 6-week sort of transition period, because there are 70,000 deals, I'm led to believe at the moment, that are in progress, but aren't likely to complete by the 31st of March. The government is not going to want to land consumers essentially with a massive bill of many thousands of pounds for stamp duty just because of the timing issue. So I think that is likely to be relaxed for another 6 to 8 weeks or so. And then the final sort of point is wealth tax and reforms to inheritance tax. Again, they've been mooted for a long time, and I think inheritance tax probably does need to be looked at in a little bit of detail, but I don't think now is the right moment. And I think a wealth tax, it's interesting, in 1995, I think 16 countries in the OECD had some sort of wealth tax. That's only 5 as of today. And I think the lessons countries have learned from that is it's terribly complex to administer. And just the complexities that arise with it. Is it one-off? Do you do it each year? How do you measure wealth? It's fraught with risk and complexity. So I do think that's unlikely. So I think that the main thing I'd say is I think there will be sentiment and a message from Rishi that taxes will rise over the next few years. But I think what we're likely to see is limited movement in this budget next Wednesday. Just moving on to COVID in the UK. I wrote these slides a couple of weeks ago, actually, so apologies that I've not updated them. And we've actually got more data now, which is pleasing that it sort of ties into what I was thinking at the time. COVID cases are down dramatically. We saw an average of 60,000 a day in January, down to an average of about 10,000 a day for the last week or so. What's really interesting for me is that the shape of our infection curve is very different to the likes of Germany and the US. Germany is an interesting one because they're in a heavy lockdown as well. And you can see it's a very shallow decline, this recent lockdown for them, whereas ours has fallen off a cliff, the infection rate. And that's quite curious for me, because I like looking into these things. And the reason it's curious is because, personally, I don't think this lockdown's as strict as the first one. I was in a traffic jam the other day. I got nostalgic. It was bizarre. Vehicle usage is a lot higher than it was during the first lockdown, which suggests more economic and social activity is taking place. But also, let's not forget, we're dealing with this Kent variant now, which has become the dominant strain, which is 70% more transmissible. Yet still, cases have fallen off an absolute cliff, which doesn't seem to make sense. And so the only thing I think can be causing this reduction in transmission and also follow-ons with hospital admissions and deaths is the vaccine program. And, I won't hark on about it, but I think it's really positive. We are world leading with it. And it is I think I heard Patrick Vallance say it's the bedrock of sort of helping us get out of this crisis. And I firmly believe it is. So just moving on to sort of markets and sort of what we're thinking about and doing at the moment and where we're positive. India is something we've liked for about 2.5, 3 years now as an economy and as a stock market. It's one of the fastest growing major economies. They've got great structural growth drivers in place. started to be implemented by Modi about 5 years ago. And what's interesting is in 2019, the percentage of the population in India that was middle class was about 15%. That's forecast to rise to about 80% in 2030. That's hundreds of millions of people that are rising through sort of salary bands and income bands that will be spending more money. And that is what's going to drive the Indian economy. And that is just a huge, huge, huge structural change to the economy. And I think India is in a very similar position to maybe where China was back in the late 80s or early 90s, where they sort of had their economic revolution. And I think India's got an awful lot of potential going forward. I mean, it is currently the 6th largest economy in the world, so it's not small. But a little map on the bottom right I find quite interesting. If you're sort of sad like me, it looks at each state in India and just puts population of another country in it. So, you can see in India, you've got a Brazil, a Germany, a Japan, a UK, Turkey, a France. I think that for me just shows the size of the Indian economy and the potential for it. And those, as I say, 600 million people under the age of 25 in a population of 1.4 billion is huge. And this is going to be an investment theme for the next 10, 15, 20 years. And we are very positive on it. But you do get quirks in the stock market. So even though India is the 6th largest economy in the world, the Indian stock market only represents 1% of the global stock market. So to most investors, it's a rounding error. They don't 1% in India doesn't make a difference, to be honest. And that's sort of led to the stock market underperforming over a period of time compared to America and other things. But it is an area we're increasingly positive on. We do have quite a good sized position in India in our client portfolios. And I fully expect this to be in our portfolios in 10 years' time, or 15 years' time, or 20 years' time. And we do take a long-term view with these things, and we're encouraged with what we've seen. The other area we're positive on from a medium-ish term perspective is property. Now, it's a very bifurcated market, and this is commercial property I'm talking about, not residential. We, for the last 2.5, 3 years, have favoured warehousing and logistics assets. For various reasons, we just have thought they are the best place to be. And what we've seen is strong structural and cyclical growth dynamics that have been exacerbated by the COVID crisis. So the graph on the bottom right-hand side just shows internet sales, basically. Internet sales have increased by over 60% since the start of this crisis. That's a decade's worth of growth, looking at pre-COVID trends, in the space of a year. It's absolutely huge. And we've got this undersupply of warehousing space. We've got this huge demand from online shopping, and that creates really favourable dynamics for the property market. And there was a report out from CBRE a few weeks ago that's showing industrial property values rose by 6.1% just in the last quarter of 2020 alone, one of the highest figures ever. And we are very positive on warehousing and industrial assets going forward. The other point I would just make is to do with cash and gilts, essentially, is, back in 2006 or 2007, you can get more money more interest rather, putting your money in the bank than investing in prime industrial property. Well, that makes no sense. Put it in cash, clearly. There's no risk with that. However, now the spread is so huge. If I was to go, and one of our portfolios does, it's got a 13-year lease with Amazon, which is at 4.6%. 13 years, the biggest company in the world, arguably one of the best companies in the world. I think that's a great place to put your money rather than lending it to the UK government for 0.5% for the next 10 or 13 years. So there's lots of strong reasons to be bullish on certain parts of the property market. And this is our portfolio at the moment. We've got 3 investments, and this is sort of like a weighted average. We've got a 13-year lease length, which I think is good, nice length of time. We're getting a yield of 5%. Most of the rents are upward only or linked to RPI, which we think is great. We've got good quality tenants, broadly speaking, Aldi, John Lewis, XPO, Amazon, DHL, Travelodge, slight issue, but it's not a huge one, and they are a good operator. They've just been hit by COVID, and we think it's a great place to be. And we think our proposition is very different to be honest, a lot of our competitors, to be quite frank with you. Most of our competitors will use diversified REITs, which have got a lot of retail exposure, which we just would not touch at the moment and haven't touched it for the last 2.5 years or so. And a lot of them would use open-ended funds, which I won't go into, but they're very risky and they're all suspended at the moment, which we saw coming a few years ago, to be quite frank. So we do feel we've got sort of a specialist expertise and exposure in this area. And, you know, a bit of a plug, but the graph on the left-hand side, just over the last 2 years, our property portfolio alone has done 20% versus the wider market that's down 4% total return. So that's a combination of capital and income. So it's an area we are positive on, we've done well on, and we think there's further to go. Now, our presentation wouldn't be complete without spending sort of 10 or 12 minutes or so talking about technology, given that it, you know, by the very medium of Zoom, you know, I never expected I'd be doing this sort of virtually. I thought it would always be physically, one would have to be physically present. And technology has had a stellar year, and it's affected all of our lives. And of course, it leads people to dot-com bubble comparisons. You know, it's a lazy argument to make. Tech's gone up a lot, therefore we're in a bubble. You know, it's the same as 1999. And you always sort of get taught in markets that this time it's different. It are the four most dangerous words, and they are, because, you know, we all sort of think this time is different, and then we get caught out. But I do genuinely believe that technology is different this time from 1999, and I'll talk about that in a second. We do have edges of the market like Tesla and Nikola and cryptocurrencies, which I'm sure some of you would like to talk about, which I think are in a bubble, and it's just irrational exuberance at its finest. And we do get weird quirks where, like, the company Apple is worth more than the FTSE 100. It's just a bit bizarre. But broadly speaking, I think we're in a good position with tech. And the reason for that is we've got such huge structural growth for tech, which have been aided by coronavirus. And these companies are highly profitable. You know, on average, they make 26% operating profit margins. They've grown at 22% over the last 3 years. And if you look during 2020, their profits were up about 50% on average. So whereas in 1999, you created a company and you added .com to the name and your share price went up 1,000,000% overnight, you know, that is stupid. Now you've got profits that are backing these huge monopolies, and that's why we're still very positive on it. We've been positive on it for a number of years, and the fund we use in the bottom right-hand graph, a fund called Bailey Gifford American, we've held this for well over 10 years for clients, and it's been a very profitable investment. But just over the last 3 years, that's done about 270% return versus the technology index doing 118% and the wider US stock market doing 55%. And again, you know, we are good at picking good funds, and being able to recognise good investments and sort of drive value for our clients through technology and through other areas of the portfolio. This is just a little snapshot of sort of markets roughly today versus 1999. So the average multiple for the large tech companies is about 30 times earnings versus 55 times in the dot-com crisis. But as I say, those earnings are backed up, those multiples rather, are backed up by profits now and entrenched positions in the market. And you get interesting statistics like this. So 82% of US households have got an Amazon Prime membership. Only 77% decorate a Christmas tree, or 68% own a pet. That is a monopoly. You know, they've got a monopolistic position. There's an argument here about whether they should be broken up. I accept that. But at the moment, they've got a monopoly, and they can charge what they want, and they will be very profitable for that. And it's the same with Google and Facebook in terms of search advertising or digital ad spend. They've got a monopoly. And this makes it very, very different to 1999. And it means they can continue to earn a lot of money. And, you know, you can see that in this slide on the bottom left-hand side. In the last 3 years, the profits of just Amazon, Facebook, and Alphabet, which is Google, have gone from 30 billion to 90 billion in 3 years. You know, that's absolutely huge. And it justifies the prices going up by the amount they have done. And so, you know, the point I make here, just in 2020 alone, profits up by about 50% during 2020 for the FANGs, but the share price was up by 51%. So essentially what you're doing is you're paying the same price to earnings ratio as you were this time last year. Profits are keeping up with share price growth, which makes, you know, the price is highly justifiable in our mind. So we think this is different to the dot-com bubble. There are certain areas of the market, which I'll come on to in a second, which we are worried about, but this time is different. They have got huge profits. Granted, valuations don't look cheap, but they don't scream bubble. And it is an area we're very positive on, again, from a medium to long-term perspective. Now, this is usually the point. Zoom can be interesting, where if I was doing this in the audience, I'd ask for a show of hands and someone to sort of say, what does all of this mean? And it gives me time to sort of sip my coffee and just take stock. But some of you may sort of get at what I'm sort of going towards here. And this is a Tesla car in the top left. It's an app called Signal. It's a company called Gamestop. It's an app called Clubhouse. And it's a picture of a little doggy, which is nice. And I am talking about Elon Musk, a person who I think invokes mixed opinions. He is definitely a pioneer and a fantastic inventor and visionary. But he is causing a bit of trouble at the moment, I think it's fair to say. So this is what he's been tweeting over the last month. He said, use Signal on Clubhouse tonight at 10 p.m. Game stonk. Stonk is the same. It's what young people apparently call a stock and a stocks and shares stonk. I don't really know why, but there you go. And he's also tweeted pictures of a fake cover of Vogue that says Doge, and also a little snippet of him meant to be in The Lion King holding up a dog. So all very sweet and nice stuff. But what we're seeing is something I like to refer to as the Elon effect, which is can be quite dangerous. I mean, to start with, Tesla rose by 900% in 2020. I'll come back to that in a second. But with Elon's tweets, he tweeted about this app called Signal that he used, and shares in Signal Advance, a completely different company, nothing to do with this company Elon tweeted about, rose by 6,000% over the next few days. Then Elon decides he'll tweet about GameStop, a lot of you will have heard about. They rise by 250% over the next few daes. Elon tweets about Dogecoin, which is a cryptocurrency, which was set up in 2013 as a joke. It is a joke cryptocurrency. It was the founders say it was set up as a joke. Rises by 900% in a matter of hours. He then goes on to tweet about Clubhouse. Rises by 60% within hours. It's a completely different company again. Again, he goes back to Dogecoin, etc., and it goes on and on and on. And these have gone up a lot, and he's sort of lured retail investors into going into these things, or by a bit of stupidity, by investing in the wrong things, and they've gone up a lot. But in pretty much all of these examples, investors would have lost over 90% of their money within a matter of a week or so by listening to what Elon Musk has said. I mean, if you're sad like me, and I did crunch the numbers because I was bored one evening, theoretically, if you'd listened to everything Elon said over the last year or so, you could have turned £100,000 into £20 billion. If you timed the market perfectly and, got out when at the top and all of that, and you would have been the 45th richest person in the world. However, in reality, you would have lost most of your money, well over 90% in all of these instances. And it's been happening over the weekend, and I'm going to rant about it for another 20 seconds, and I promise I'll stop. He's been telling people over the last month or so, cryptocurrency is great, Bitcoin's great, Tesla's investing in Bitcoin, isn't it wonderful, invest in Dogecoin. And then he says at the weekend, they're a bit high now, aren't they? Lol, laugh out loud. And they've all crashed. Bitcoin lost $200 billion in value yesterday, it was down 20%. And it's retail investors, it's the man on the street that's losing money here. And I think what you will see is regulators start to come down on him quite hard, because he is moving markets in a significant way. And it's not professionals that are losing money. It is the man on the street that's losing money because of him, and it's dangerous. This is another example of stupidity in the market, and it exists everywhere. The FANGs, Facebook, Apple, Amazon, Netflix, Google, people thought that FANGed Network Group, which is a Chinese property company with no property by the looks of it, was these companies, some sort of amalgamation. And the price rose by 1,500% in a matter of hours, and then fell by 90%. It's just stupidity. And then the biggest example of this we've seen is GameStop, which is like HMV but worse, basically, and just focuses on games. And there was a gang of retail investors that sort of teamed up, and they were spot on with their analysis that this company was heavily bet against, and they could sort of make the price go up. And it was a great trade, to be honest, but it got a bit too frothy. And so the price of GameStop went from $2 in 2020 to $500, 250 times return. And you saw, again, retail investors get sucked into this and buying shares at $200, $300, $400, $500 a share. Shares today are about $50. I heard an interview. I was driving back from the office a few weeks ago, and we were in the sort of the teeth of this GameStop issue. And it was a a young chap, I think from Coventry actually in the UK, and he put his life savings of £20,000 into it at like $200 a share. And so at the time, the share was like $400. So he was, happy days. And the host, I think it was Evan Davis, was trying to tell him essentially to take some profit out and all of that. And he was like, no, it's going to $1,000. I'm going to keep it in. Well, now he's lost all of his money, basically. It's gone down at $50. And again, it's the retail investor, it's the man on the street where they don't necessarily have the knowledge and the education about these things, where they lose a lot of money. A small group may make a lot of money, but a lot of people lose a lot of money. And I think it's very sad and a sad state of affairs, to be quite honest. Just quickly on Tesla, I mentioned it rose 900% in 2020, a wonderful increase in the price, but they only increased car deliveries by 36% to about 500,000 cars. They did increase their profits from a loss of 800 million to a profit of 700 million. Interestingly, I just mentioned that Elon Musk invested in Bitcoin via Tesla. Tesla put £1.5 billion into Bitcoin. They made more money in a week investing in Bitcoin than they made all of last year selling cars. A little interesting point aside. But anyway, Tesla's now worth $780 billion, trades on over 1,000 times profits. But what for me, which really, is why I think there's something not quite right here, is Tesla is worth more than 30% of all car manufacturers combined. Toyota, Nissan, Volkswagen, BMW, all of that, it's worth 30% more than all of those companies combined. Yet it has got a market share of less than 1%. So it's 1% roughly of the global cars that are sold each year. And you can put forward that Tesla's a tech company and, green energy and all this sort of stuff, but the price is wrong, to be quite frank. And this is an area of the market where I think we are in sort of bubble territory. Just moving on, we're on the home straight of the presentation. I'm sure all of you will be glad to hear. I always put this little graph in, which is essentially to say stock markets are volatile. The red dots show for each year at some point how much the FTSE has fallen. So you can see lots of red dots, and it's quite common for the FTSE to fall more than 10% in a year. But what's important are the grey/black bars, which show the end of year results. So what this graph is showing is that it's very frequent for markets to fall in the year, but more often than not, markets do finish the year in positive territory. And so, the trade-off for getting better returns by investing in the stock market over the long term is you've got to stomach this volatility. And it is always going to be the case. Last year was pretty extreme, I'm not going to lie, but it does happen, and it's going to happen this year. I'll wager now that the market will fall 10% from its point now at some point this year, but I'd wager that the market will finish the year higher than it did now. It happens all the time. So another sort of pet peeve of mine, which I think is so important, is sort of compound interest. I know you're all sort of laughing and thinking I'm sad, but I'm thinking about you, really. How many people know exactly what their pension is invested in? Exactly what it's invested in, what that fund manager is like, what their performance is versus other funds they could be invested in. I'd wager a lot of you might not. Some of you will, but some of you may not. And the graph on the top right is just a little example. I've just taken £1 million pot as a just to make numbers round. If you invest £1 million and get a 3% return over 40 years or so, you'll turn that £1 million into £3.5 million. Fair enough. However, if you get a 5% return, you'd turn it into £7 million. Now, to most people, the difference between a 3% return and a 5% return a year doesn't sound huge, does it? It doesn't really sound like there's much of an issue, to be honest. But you've got this effect over the long term of compound interest. And it is so important that you know how your money is invested, because even if you're just paying a little bit too much, or you're investing in the wrong manager, or not taking the right level of risk for how you should be invested to meet your goals, it can make huge differences later on down the line. So if you could take one message away from this presentation is, please make sure you know what you are invested in, and that it is appropriate and is likely to meet your goals over the long term. And that is, of course, something we can help with if people want. The only other point from this slide is cash is a great asset class to have during market crises in portfolios, and we held cash going into crisis last year, which is great. It's atrocious as an asset class over the long term. We come across people, of millions of pounds in the bank, and they have done for the last 10 years, and it's it's not sensible from a long-term planning perspective when you get nothing for cash in the bank, and inflation is averages 2%. This is, I always put this in, I just quite like it. I don't know why. There's a lot of noise in the market, lots of ups and downs, noise every day. That is our job to think about this, but we try and think decades ahead. And over the decades and decades that I will be investing clients' money for, markets will be higher. I can tell you that for a fact. By the time I retire, markets will be higher than they are now. And so it's important to sort of recognize the noise that goes on day to day and try and take advantage of that noise and that volatility. But it's very important to have a long-term time horizon and think many, many years ahead. And that's how we do. And that's what we're doing with our investments at the moment. And this is how we're positioned. We still like technology. We've got a lot of technology exposure, a lot of healthcare exposure. We've had that for about 4 years, and it's really done well over the last year, as you can imagine. A lot of warehousing and logistics exposure. We do like parts of the UK stock market, predominantly the small and mid-cap end of the market, not necessarily the FTSE 100. And we do have this barbell approach in portfolio of sort of high-growth tech stocks, but also battered and bruised, unloved sort of COVID stocks, via some of the funds we've got. We've got airlines, we've got pub companies, things that, really have been hurt a lot, but will start to recover in the coming months. This is just a brief slide on performance and just sort of how we think about things and a bit about our track record. So over the last year or so, the graph on the bottom left is one of our adventurous portfolios. We managed to do in over a year a 13% return versus the FTSE being down 10%. So we're very comfortable with that outperformance compared to the FTSE, also compared to cash, inflation, and our peers. But also it's the long-term performance that we're especially proud of. Is this particular portfolio over over the last 10 years or so is up 131% versus the FTSE up 57%. And this is with us taking less risk than the FTSE. This portfolio has only got 80% in equity, whereas the FTSE is 100%. And again, beating our peers. So, we do feel we've got a very strong long-term track record of performance and a short-term track record. And, we do feel we add good value for clients. So you'll be pleased to hear this is the last slide, and then I can take a sip of coffee and just sort of relax my vocal cords after 30 minutes or so. So where are we going forward? Well, we like industrial and sort of long income property with long leases. We're really positive on that. We like healthcare, tech. The smaller end of the UK market we think is really, really attractively priced. Now Brexit sorted and sort of COVID is hopefully getting sorted. And we do like emerging market equities and Japanese equities due to economic growth and sort of valuations. We're a bit more nervous on corporate debts, FTSE 100, American equities because of valuation, and sort of neutral on European equities and cash also. But the areas we're especially negative on, and this last bit of the slide with the red traffic light has been the same for 2 years now, I think, or 3 years. I don't think I've changed it. Negative debt. There's $18 trillion globally of bonds that will guarantee you a negative return if you buy them now and hold them to redemption. It's just bizarre. Don't go near it. It's the greater fool theory in play. And a lot of that is sovereign debt, as I've mentioned. We've been very, very nervous of high street property for a number of years and continue to be. The structural changes that we're seeing in the UK economy are going against high street property, and that's just been accelerated by the COVID crisis. We are very, very reticent of that area. And also staff fund managers. I'm sure we're all delighted that Woodford's back on the scene. It brings joy to my heart and a song to my lips. But we are very wary of staff fund managers. You've got to take some of them with a pinch of salt. And, pleasingly, we did invest in Neil Woodford about 4 years ago, but we sold about 18 months before the funds closed. Because of our rigorous due diligence process, we could see things were going wrong, liquidity was deteriorating, his style was changing, and we got out well in advance of any issues. But we are nervous on staff fund managers. So look, that is presentation over. I hope people have found it interesting, and I'm very happy now to answer any questions that any of you have got. So yes, thank you very much for listening. One from Steve Sutton. Please outline your thoughts on the outlook for Latin America. So Latin America is an area of sort of global stock markets where most investors don't tend to allocate specifically. You wouldn't allocate to a Brazilian fund or a Chilean fund or an Argentinian sort of fund because it's quite small and it's quite high risk, or certain economies are. Where we do have a bit of exposure is we have sort of emerging markets exposures, and they will tend to allocate maybe 10-15% to Latin America of those funds. I think I probably don't have a terribly articulated view on Latin America. I think certain parts of the continent have handled the COVID crisis quite well and are still in a relatively strong position. Brazil has taken the brunt of it, I think, for the continent. They've had 250,000 deaths, and of course have got one of the nasty strains that originated in Manaus. However, I think the issue with Latin America, I mean, roll back 20 years when Lord O'Neill coined the phrase BRICS: Brazil, Russia, India, and China, and South Africa as well. These were the economies that were going to power, the world going forward. And we've not really seen that. India's not really done it yet. We're positive that it will. China has definitely done it. But South Africa, I know it's not in Latin America, hasn't. Russia hasn't. And Brazil haven't. And I think the issue with Brazil, to be quite frank, is corruption. And it is a gross mismanagement of the economy, which deters investors. And especially when you've got so much volatility in the currency. So I think there probably are, certain attractive assets in Brazil you could buy, but I think it's very risky. And at the moment, I can't see much of a way out for them in terms of successfully managing the economy and sort of tackling the bureaucracy and the corruption that exists. So it's an area we've got a tiny bit of exposure to via our emerging markets funds, but I think there are better emerging markets to invest in, such as India or China, rather than maybe the economies of Latin America is what I'd say. I hope that answers your question, Steve. Roger has come through with a question. Excellent, Roger. Hi, Sarah. Interested in view of interest rates and likelihood of negative rates in the UK. I think that's meant for me, even though it says hi, Sarah. Unless, Sarah, you want to take the
no,
the
I think it is definitely meant for you, Dan.
So the short view is interest rates aren't going up anytime soon. I think there will be talk of interest rates potentially going up because of this inflation that we're potentially going to see. But I think it's a short-lived issue, the inflation, and if the bank puts up interest rates, that they kill off the economic recovery, and they're not going to do that. So I think interest rates are going to stay low for 3 to 5 years at least, I would say, if not longer. Look at the financial crisis. Went into it in 2008, 2009. Interest rates went to sort of 0.5%. What did we get up to? Managed to get up to 0.75 in 2019 before the crisis. These things take a long, long time. So, it wouldn't shock me if I'm sat here in 10 years talking to you all that interest rates are still around this level, to be honest. In terms of negative rates, I think it's going to happen, to be honest. Broadly speaking, we're out of firepower from a monetary policy perspective. Yes, you can do a bit more QE and sort of target the fixed interest curve. But interest rates, it's nothing. What is the UK interest rate? 0.1%? Okay, move it to 0. It's nothing. It's a rounding error. So I think you might see the bank move into negative territory. It's a fascinating one because I don't think it's actually been proven to have a good effect on stimulating the economy. Japan and the Eurozone have clearly moved into negative territory over the last decade or so, but it creates weird behaviours and doesn't get the desired effect. So, for example, the story in Europe was, okay, we're going to move to negative rates, and that will mean people will spend lots of money because they don't want to sitting in the bank, and we're taking the money off them in the bank, earning negative interest. However, what they saw was actually people saved more money because they realised they needed to put more money in to save it for their retirement, essentially. So it had the complete opposite effect of what policymakers wanted. So I think it is likely to happen in the UK, but only in a very marginal way. And I think it, broadly speaking, probably won't have the desired effect, but I do think it is likely to happen at some point over the coming years. And I think Bailey has sort of said that he's open to the ideas. So yeah, it would not surprise me at all if we do see rates go marginally negative in the UK.
That's great, Dan. Thank you. So just Andrew saying thank you for a great presentation, and he loved it, Elon Musk stats. I think that we all found those really interesting, didn't we? So I think it only leaves me to thank BRI and Dan in particular for a really thought-provoking presentation as usual, and have a great morning, everybody, and we will hopefully do another one of these sessions soon. And no doubt we all look forward to the budget eagerly next week. So thank you, everyone. Have a great day.
Thank you, everyone. Cheerio.